Welcome back to the Pro Ticker Podcast, everyone. Your Tuesday morning edition covering major financial magazine headlines.
Absolutely.
Yeah, it's been pretty hard to ignore what's been happening in the U.S. stock market lately.
Right.
The volatility has definitely got everyone's attention, I think it's safe to say.
Yeah, I think that's fair to say. And those who aren't paying attention are probably wishing they were now.
For sure. For sure. I was actually reading a really fascinating piece on MarketWatch, and it was from Bespoke Investment Group. And they were pointing out that some of these recent market moves we've been seeing are being compared to some really significant historical periods,
Wow.
like the 1987 crash
Oh, wow.
and the 2008 financial crisis.
Oh, yeah.
So that kind of gives you a sense of the magnitude of what we're looking at.
Yeah, it certainly does. I think it highlights that level of concern and uncertainty that's kind of rippling through the markets right now. And those aren't comparisons that are made lightly. So I think it suggests that investors are grappling with some potentially serious underlying issues.
For sure. And I think that's a really good point to start off our deep dive today.
Hmm.
What is it about this current market sell-off that feels so unusual? And what are the big financial headlines telling us about why this is happening and what the potential fallout could be?
Yeah.
We've gathered a range of articles from leading financial publications to really dig into this for you. The Learner.
Sure.
Our goal is to help you understand these key factors driving this unusual market behavior and the possible implications, all without, getting lost in the weeds.
Yeah, cutting through the noise.
Exactly.
Providing some clear context so we can, by examining these different perspectives and data points, we can kind of start to piece together why this market episode stands out.
Exactly. Okay, so let's dive right in.
Let's cue it.
One of the first things that I thought was really interesting that emerged from this MarketWatch article, 5 things that make this stock market sell-off truly unusual. It talks about how Wall Street's expectations for how much money major corporations will earn this year has actually remained surprisingly steady. And this is according to data from FactSet's John Butters.
Interesting.
So what makes this so noteworthy, The Learner, is that this is so different from what we've seen during past significant market downturns.
Okay.
The article specifically contrasts this with what happened during the COVID-19 crash in 2020.
Right.
So if you remember that period as the S&P 500, which represents the performance of 500 large U.S. companies, was experiencing a sharp decline, analysts were rapidly lowering their earnings forecasts.
Yeah, I mean, that makes sense. That makes sense.
You would think so, right?
Yeah.
So the article points out that back in March of 2020, earnings estimates had already dropped by almost 3%, while the S&P 500 was down by more than 20%.
Wow.
This time around, since the beginning of 2025, analysts have only trimmed their profit estimates by about 1.7%, even with a substantial market decline.
So what does that discrepancy tell us?
Well, that's what's really interesting, right?
Okay.
So Michael Kantrowitz at Piper Sandler, as highlighted in this piece, interprets this to mean that the current sell-off is primarily being driven by fear.
Oh, wow.
It's not necessarily based on a fundamental belief that companies are going to earn significantly less money.
So it's all psychological.
Yeah, isn't that fascinating?
That's a really good point.
You would think that a big drop in the market would be linked to, a downward revision of how profitable companies are expected to be. But the idea that this is more about investors feeling anxious rather than actual concrete earnings problems is a key takeaway.
That's a great point. And, I think it makes you wonder, The Learner, what exactly is fueling this fear? If the earnings outlook remains relatively stable, it suggests that investors might be reacting to a perceived risk in the broader economic or policy environment rather than just the companies themselves. And that's something we should probably keep in mind as we go through this deep dive, that maybe it's not the fundamentals, it's something else that's causing this volatility and this sell-off.
It's a really good point, and this could present opportunities down the line because if earnings do hold up and those fears subside, maybe there's some good buying opportunities, but we'll just have to see.
Yeah, we'll have to keep an eye on it.
Exactly.
Yeah.
Okay, so speaking of unusual market behavior,
Okay.
the second point in that same MarketWatch article focuses on the really dramatic declines we've been seeing right at the start of trading each day.
At the open.
Yeah. So apparently, S&P 500 futures, which allow investors to bet on the future direction of the S&P 500, were down more than 1% right at the opening bell for 4 consecutive trading sessions.
Oh, wow.
And that's a pretty significant and unsettling way to start the day.
Yeah, it is. And what makes it noteworthy, The Learner, is that it's so rare.
Okay.
According to Jason Gupfert at Sentiment Trader, this has only occurred one other time in the history of the futures market since 1982.
Only once before. When was that?
You're gonna recall this. You're gonna remember this. It was right after the failure of Lehman Brothers
Oh, wow.
in September 2008. So that was a pivotal moment in the global financial crisis. And to see this kind of immediate negative sentiment reflected in the market openings now is quite striking.
So we're seeing a market reaction at the open that is comparable to right after a major financial institution collapsing.
Exact.
That's pretty incredible.
Pretty wide.
Yeah, and puts it into a historical context.
Yeah, it gives you some perspective for sure.
Absolutely. The article also mentioned that Gopfert looked at previous sell-offs with similar opening declines, and very few of them saw a decline of this overall magnitude.
Right. So we know the speed and the intensity of the selling pressure that we've witnessed is pretty unusual, even when you compare it to other periods of, significant market weakness. So it's just another detail that really underscores how unique this market episode is.
Absolutely. Okay, so let's move on to something that I thought was really interesting.
Okay.
The U.S. dollar has been weakening at the same time as the stock market has been declining.
Okay.
So now typically, wouldn't you expect the dollar to become stronger when stock prices are falling?
Yeah, I mean, that's the conventional wisdom because, investors are looking for safety and security, and the dollar is usually seen as a safe haven asset.
Exactly. So that's generally been the observed pattern since the 2008 financial crisis.
Right.
But this MarketWatch article points out that since February, both the S&P 500 and the U.S. dollar have been weakening.
At the same time?
At the same time.
Wow.
And this trend seems to have become even more pronounced following President Trump's recent tariff announcements.
So this is definitely unusual.
Yes.
And Steve Englander at Standard Chartered, he draws this really interesting parallel to the peak of the dot-com bubble.
Oh, well, okay.
Around the year 2000, where we saw a similar pattern emerge. And his explanation, I think, is key here.
Okay.
He suggests that the reduced inclination for investors to rush into the dollar as a safe haven indicates that this isn't a liquidity problem or a problem in the credit markets.
So if there aren't these widespread concerns about banks failing or a general freezing up of lending, then there's not this urgent need to pile into dollars as a safe store of value.
Yeah, which would make sense because we saw that happen in 2008.
Exactly.
But we're not seeing that now.
Right. So this deviation from the norm could signal a shift in the dollar's traditional safe haven status.
Potentially.
Yeah.
And, I'm wondering if it has something to do with the very policies they're contributing to the market volatility.
That's a good point.
Yeah.
Okay, so this MarketWatch article also raises this important point about the growing influence of passive investing strategies.
Oh, okay.
And these sophisticated volatility targeting strategies employed by some hedge funds.
Right.
So how might these be contributing to the unusually rapid pace of the market sell-off?
This is a really crucial aspect, the learner to understanding how modern markets function.
Okay.
So over the past decade, as the article highlights, the amount of money invested in passive strategies that just track broad market indexes has roughly doubled the amount held in actively managed funds. So think about that. A much larger portion of investment capital is now essentially tied to the overall performance of the market rather than, specific stocks.
So it's all just going up or down together.
Yeah, and Jordan Rizzuto at Gamma Road suggests that this increased concentration of holdings within passive strategies can amplify sell-offs.
How so?
So when there's widespread selling pressure, these passive funds are forced to sell across the board, irrespective of the fundamentals of any individual company.
So they're not picking and choosing?
No, they can't. They just have to sell.
Wow. So that would create like a snowball effect.
Exactly.
Pushing prices down much more quickly.
For sure.
Okay, and what about these volatility targeting strategies?
Yeah, so think about these funds as having like a built-in risk dial.
Right.
They use leverage to potentially enhance their returns.
Okay.
But they also have mechanisms to automatically adjust their market exposure based on how volatile the market is. So when volatility spikes, like we've seen recently, their risk dial turns down, and they're forced to rapidly reduce their holdings of stock to decrease their risk.
So increased volatility triggers selling by these funds, which then pushes prices down further and increases volatility even more.
Exactly. It's like a self-reinforcing cycle.
Wow. So it just keeps feeding on itself.
Pretty much.
So the interconnectedness of these sophisticated trading strategies and the sheer scale of passive investing could be contributing to the speed and depth of the market's movements.
I think so. I think that's a very fair statement.
Okay, so the next point in this article I thought was really interesting. It refers to this whole sell-off as a grenade in the foxhole.
Okay, a little bit dramatic, but okay.
It is a little dramatic,
Yeah.
but it suggests that these policy decisions, specifically the tariffs that seem to have sparked this volatility, were largely self-inflicted.
Right. So Ben McMillan at IDX Advisors, he uses that very vivid analogy, and he really emphasizes that this isn't necessarily a market-driven crisis stemming from, economic weakness. It's more a consequence of specific policy choices that have unsettled investors.
And it's not just, bearish investors that are sounding the alarm. The article mentions that even asset managers who've been generally supportive of President Trump have expressed concerns about the tariffs.
Wow.
Even prominent investor Bill Ackman called for a 90-day pause on their implementation to allow for negotiations.
Yeah, I mean, it makes sense if everyone's kind of coming together and saying that maybe this isn't the right approach.
Yeah, and it really does underscore the potential significant impact of these policies.
Right.
But we do have to consider another perspective here.
Okay.
And this comes from a separate MarketWatch article featuring Andy Beal, who's described as the nation's wealthiest banker.
Okay.
He takes a very different stance.
Okay.
He argues that President Trump is absolutely on the right track with these so-called shock and awe tariffs, and that any pause would be a mistake. So he believes that the tariffs are a necessary tool to bring other countries to the negotiating table and to fundamentally recalibrate the United States' role in the global economy.
So he's taking a very strong stance.
He is.
Okay.
He argues that the U.S. has been operating under kind of fantasy for decades, masked by artificially low interest rates and substantial government deficit spending. He contends that the large trade and fiscal deficits that we've been running are simply unsustainable in the long run, and that these tariffs, while they might cause some short-term pain,
Sure.
are a necessary form of shock therapy to address these deep-seated imbalances.
So he's saying that the U.S. needs to kind of reset,
Exactly.
and he's not afraid to use these tariffs to do it.
He's not, and he very clearly states that he disagrees with those calling for a pause,
Okay.
like Bill Ackman. And he's saying the opportunity to reshape U.S. economic policies is now and we shouldn't delay.
Wow, that's a strong statement.
It is a strong statement, and it really just highlights the significant disagreement
Yeah,
about the underlying drivers of this market volatility.
absolutely. And I think, this policy-driven nature of the sell-off also has ramifications on a global scale, particularly in terms of how China is reacting.
Okay, so how are they reacting?
Well, there's a Bloomberg article. China vows to fight to the end if U.S. insists on new tariffs.
So they're not backing down.
Not at all.
Okay.
In fact, the Chinese Ministry of Commerce characterized the U.S. threat as a mistake on top of a mistake.
Wow.
And they stated very clearly that China will fight to the end if the United States persists on this current course.
So are we on the brink of a trade war?
Well, this rhetoric certainly raises the specter of a prolonged trade conflict and one that could escalate. And it's not just words. The learner China is taking steps to try and support its own financial markets.
Oh, okay. How? So
Well, they're considering loosening their control over the value of its currency, the yuan, and they're promising to provide loans to kind of stabilize the domestic markets.
they're trying to, mitigate the potential negative consequences of the U.S. tariffs.
Exactly. And Michelle Lamb at Societe Generale suggests that if the U.S. doesn't back down, investors may need to prepare for trade decoupling between the two countries.
That would be huge.
It would be.
So we're seeing indications of specific potential retaliatory measures that China might be considering.
Like what?
So MarketWatch published an article that cited influential Chinese bloggers who often have close ties to state media,
Okay.
suggesting that Beijing is considering targeting U.S. agricultural products like soybeans and sorghum.
Okay.
They're thinking about potentially imposing a ban on imports of U.S. poultry, placing restrictions on U.S. services, including legal and consulting firms, and even reducing or entirely banning the import of U.S. films.
So it sounds like they're really thinking about all their options.
It seems that way, and it really does kind of make you wonder, are these just idle threats, or are these things that they're really seriously considering?
Yeah, I mean, especially coming from these bloggers that are connected to state media, it makes you think that maybe they're not just throwing this out there.
Yeah.
They're really thinking about it.
And then they even mentioned that they might suspend cooperation on fentanyl-related
Yeah.
issues.
Oh.
So it's becoming more than just a trade dispute over goods and services.
Yeah, and I think it really underscores just how interconnected the global economy is
Yeah, absolutely.
and how these actions have consequences, that reach beyond just economics.
This Bloomberg article, Trump tariffs, China trade, threatened world economy, global investments,
Hmm.
really emphasizes these anxieties, describing them as twin colliding shocks to the global economy.
Twin colliding shocks, that's pretty powerful imagery.
It is.
It really highlights how investors across the globe are now trying to reassess and reprice risk in the face of these very different visions for international commerce.
Right. And,
Huh.
and what does that even look like? What does that future look like?
It's a great question, and there are some really big questions that need to be answered.
The potential for global supply chains to be significantly disrupted, for long-term investment plans to be completely rewritten, and for the prices of imported goods to spike considerably, that's all creating a significant amount of uncertainty and volatility in the markets worldwide.
And it's not just about, the immediate impact. The learner there was a Bloomberg economics analysis that tried to quantify the potential long-term impact.
What did they find?
They're predicting pretty significant drops in U.S. imports from a variety of countries. Not surprisingly, China is the most affected, but they're also anticipating reductions in imports from other major U.S. trading partners.
So this is a really big deal.
It's a huge deal, and it suggests that even countries that aren't facing direct tariffs from the U.S. could see their exports to the American market slow down.
Yeah, as a result of these broader shifts
Exactly.
in global trade patterns.
Right, so the impact is far-reaching.
Absolutely. And then the article also includes a rather concerning statement from Larry Fink.
Okay, who's that?
He is the CEO of BlackRock.
Okay.
And he says that the majority of CEOs that he's been speaking with actually believe that the U.S. is likely already in a recession.
Wow.
And so this is a pretty significant statement coming from, a major global asset manager.
It is, yeah.
And BlackRock themselves have downgraded their outlook for U.S. equities to neutral.
Right.
And they're citing these escalating trade tensions as the reason.
Right, so they're not seeing things getting better anytime soon.
Not really. And then Goldman Sachs has also reportedly issued a warning about the potential for a longer-lasting cyclical bear market
Oh, wow.
and has increased its internal probability forecast for a U.S. recession.
So it sounds like the potential for a significant economics slowdown or even a full-blown recession is a major concern.
Definitely, and it seems very directly linked to these ongoing trade policy decisions.
Yeah, and that Bloomberg article we were talking about earlier quoted a trade policy expert at Dartmouth University. And this expert suggested that many people are underestimating just how damaging President Trump's tariffs could be on U.S. production as well as on the broader global economy.
So you're saying the level of uncertainty that these policies are injecting into, the decision-making process
Right.
could have long-lasting and negative consequences.
Exactly.
Okay, so amidst all this bearish sentiment, are there any contrarian viewpoints emerging?
Yeah, there are always contrarian viewpoints.
Always.
So the Wall Street Journal article, How Far Does the Market Have to Fall Before It's Time to Buy,
Okay.
offers some alternative perspectives.
Okay.
James McIntosh acknowledges the significant market decline,
Of course.
but he also raises the point that a considerable amount of negative news and potential risks may now already be factored into current stock prices.
Okay, so you're saying maybe we've already hit the bottom.
Well, he's suggesting that some investors who are willing to take on risk and have a longer-term view
Right.
might start to cautiously tiptoe back into the market.
Yeah.
He mentions a few specific things that could trigger a rebound.
Like what?
So, President Trump softening his stance on tariffs,
Okay.
other countries deciding not to retaliate as strongly, or even intervention by the Fed, our central bank.
Okay, so those are some things that could potentially turn things around.
They could, but McIntosh also raises a really important caveat.
Okay, what's that?
He points out the Fed's likely reluctance to try and actively rescue the markets from the consequences of deliberate government policies.
Right, so that could limit the effectiveness of those monetary policy tools.
Right, because normally they would step in, but if this is because of, actions by the administration, they might be more hesitant.
That's a good point. And is everyone who is, expressing concern about the market expecting a relatively quick bounce back?
Not necessarily.
Okay.
So Mark Spitznagel, he's an investor with a consistently bearish outlook.
Oh, okay.
Believes that the current plunge is a trap
Oh, wow.
and that a much larger crash, potentially 80%, is still to come.
80%. Wow.
He said that in a recent commentary on MarketWatch.
Wow.
He thinks that the current volatility is just a phase in the lead up to that larger correction.
So we really have a divergence of opinions on where the market's headed from here.
Yeah, ranging from those who are, optimistically looking to buy to those who are expecting a much more significant downturn.
So it's really hard to know what's going to happen.
It is. The learner and the level of uncertainty and disagreement among experts right now is quite high.
Okay, so let's shift gears and talk briefly about the cryptocurrency market.
Okay.
So this MarketWatch article, Bitcoin could crash below key support level as resilience seems short-lived, suggests that Bitcoin's recent price decline and the general level of the VIX, which is referred to as the fear gauge,
Right.
are making it more difficult for investors to focus on digital assets like Bitcoin.
Right. So when traditional markets get shaky, investors tend to shy away from riskier assets.
Right, they want to go to that safe haven.
Exactly.
But that's not really happening right now.
It's not.
And the article highlights Bitcoin's vulnerability to those broader market forces and investor sentiment.
Yeah, and they suggest that if Bitcoin breaks below a certain price level, we could see more declines. It's all
Right.
based on, technical analysis and charts.
Okay, so it's not looking so good for Bitcoin.
Well, I mean, we'll have to see, but it's definitely something to keep an eye on.
Okay. But then Bloomberg reported on the launch of a leveraged exchange-traded fund, ETF, that's linked to the cryptocurrency XRP.
Oh, wow.
So it seems like there's still some appetite for these digital assets.
Yeah, I mean, despite the caution in the market, there are still some people who are bullish on crypto.
Okay, and then moving on to some international economic news.
Okay.
There was an article on Bloomberg about a German debt package that's expected to potentially add a lot of revenue to the banking sector in Germany.
So this is interesting because it shows how policy decisions in one major economy
Yeah.
can have ripple effects on the domestic financial industry.
Okay, and then we also saw a Bloomberg article about a port in Brazil that's experiencing increased activity
Okay.
as China potentially looks to shift away from the United States for certain commodity imports.
Right. So they were looking for new suppliers.
Exactly. And then there was also a MarketWatch article about the Swiss National Bank arguing that their trade deficit with the U.S. is being distorted by the gold trade.
Interesting.
So even the data used to justify tariffs can be debated.
For sure. And I think this all really speaks to the complexities of the global economy
Absolutely.
and how intertwined everything is.
Finally, despite all this market turmoil, Wall Street's median targets for the S&P 500 still suggest a significant rally from current levels by the end of the year.
Wow, that's surprising given everything we've been talking about.
It is a bit surprising,
Yeah.
but Lori Calvasina at RBC Capital Markets cautions that these year-end targets should be viewed more as a compass
Yeah.
than a precise prediction.
Right, because with so much uncertainty, it's really hard to predict what's going to happen.
Exactly.
Yeah.
Okay, so let's summarize some of these key takeaways.
Yeah.
We've seen a sell-off that's characterized by some unusual signals.
Right.
We have stable corporate earnings, but a declining market.
Yeah, that's not something you see every day,
We've seen huge drops in stock futures right at the open.
which is a very rare occurrence.
Extremely rare, and we've seen the U.S. dollar weaken alongside falling stock prices.
Right.
So that's also not typical.
Not at all.
We've explored how the increasing role of passive investing and volatility targeting hedge funds may be amplifying market moves, and then this downturn appears to be largely driven by these policy decisions, and specifically President Trump's tariffs.
Which have caused a lot of controversy
They have.
and a lot of strong reactions from China.
Yeah, and we've touched on the significant global interconnectedness, with China's response and these potential opportunities for other nations.
Yeah, and I think it all highlights just how far-reaching the consequences of U.S. trade policy can be.
Absolutely. And there are those contrasting views on the likelihood of a recession and the potential for the market to find a bottom.
So it really is a mixed bag.
It is a mixed bag.
Yeah.
So the learner, considering all of these unusual factors and the very different expert opinions, what does this tell you about the predictability in financial markets?
I think it really shows that nothing is certain.
And it's really important to understand the underlying economic and policy drivers that are shaping our world.
Absolutely. The learners stay informed, consider multiple perspectives, and remember market behavior is often influenced by complex factors that go beyond just the numbers.
Well, that brings us to the end of our deep dive for today. We'll see you all tomorrow morning with new headlines from major financial magazines.
See you then.
Bye.